advantage. Our baby boomer population is just beginning to enter the phase of retirement. Of course, people can forestall that and continue to work if need be, but our main problem over the next 10 years seems to be the $70 trillion unfunded liability between Social Security, Medicare, and Medicaid. And a lot of that ballooning is as a consequence of our demographic. It seems that we're perhaps on the same trajectory, just perhaps behind Europe. Europe is already past the peak. You're saying Asia is near the peak, and perhaps we're near the peak, but not quite as close as China. Is that fair?
Wouldn't want to be claimed to be an expert on America's demographic system and your social security structure, but this is a relative matter. The balance between aging people and young people, the fertility rate is much closer to an equilibrium level than it is in large parts of Europe and certainly in China or Japan. So while you will face these problems, they won't be as acute in 10 or 15 years' time as they will be in any of the other regions that people tout as possible competitors to American power. So in a relative world, I think you'll hold up better. I also think with a slight tweaking of the retirement age, you can actually bring the Social Security structure into reasonably good balance. I don't think it's as nearly as bad as some of the unfunded pension liabilities we're facing in Europe. I do think probably the bigger threat for the United States is on the healthcare side, where that does not seem to be under control. The healthcare costs, I don't know what they're at to now, is it 16 or 17% of GDP? It seems to be extremely high. It's about 10 or 11%, I think, in Britain, and some of the other European countries maybe a little bit more. And I don't think, on balance, the health indicators, if you like, are that different on each side of the Atlantic. The life expectancy and so forth is not that different. So it seems to me you're paying about 5 or 6% of GDP extra for a service that doesn't really bring a much greater benefit to the society. And I would think you're going to have to sort that out, because once the aging population gets greater, this could get up to 20-25% of GDP, and then you've got a real problem. And that's where I would see the challenge being.
That may change tracks during the next administration, where we're likely to see more or less a socialized medical system. Quick comment, if you would, just on the U.S. dollar. We've seen a significant decline off of its peak of 1.2, now down in the 0.72 range, and the euro at the same time has been setting new records, over the last 3 to 6 months. Would that indicate to you that there is a power shift? And I think you're arguing demographically and perhaps politically for instability in Europe, but there seems to be a shift.
Firstly, on the dollar itself, I think it's a classic bottom. This is what happened in the kind of 88 to 92 period. And then you had another sort of run for over a decade when it recovered. I just think, I think it's been pushed down far too low beyond its natural value. And what we're seeing is a huge boom for American industrial exporters. I mean, look how Boeing's outcompeting Airbus quite dramatically. And I think, the great story, if you like, almost is the comeback of American heavy industry, at least compared to some of the other countries which are now, really desperately trying to cut costs. And you can see, Volkswagen and Airbus now all talking about building new plants in the United States because they can't produce stuff in Europe at a profit. That's the first point. I mean, I think the great 7-8 year decline of the dollar is over. I mean, maybe it could carry on going down for another 3 months. I don't know. But, will it be lower in 2 or 3 years against sterling, against the euro? I don't believe that for one moment. I think it's going to recover quite strongly. Now, on the euro, I think people overlook. They just see it as if it's a comparable currency to the dollar. But there's no European government. There's no European state. There's no European treasury. There's no European social security system to back it up. All the mechanisms that exist in the United States to back up the dollar when the economy is in real trouble, in a recession, and you've got parts of the country in much worse trouble than other parts of the country, you have automatic fiscal transfers, because 20% of the budget goes through Washington. There's money that's automatically transferred through the tax system from the countries that are booming to the countries that are in bust, and that helps stabilize it all. None of this exists in Europe. Not only that, it's actually illegal under the EU treaty system. So, Spain gets into trouble, as we've got now. Housing market is completely disintegrating in Spain. There's nothing that could be done to bail them out. There's a huge gap that's developed between the north and south of the Eurozone over the last 10 years. Essentially, Italy has lost 40% in labor competitiveness against Germany internally since 1995, roughly. Spain's probably lost about 32%. France has lost about 20%. These are huge changes, and it's getting worse. I mean, it's still getting worse. It's not getting better. The gap is getting wider and wider and wider until it's going to blow up. And the problem is the fact that they share this currency has kind of acted as it sort of helped them continue with self-destructive policies for longer than they would otherwise have got away with. If they were not in the euro, the markets would have called time on this already, and they would have had some kind of mini crisis, and they either would have had to get their act together or they would have devalued. The euro sort of shields them from the realities of the world market, but only for a time. And those realities will catch up with them, are catching up with them, and then there's going to be a very, very, very major crisis. And is this going to happen this year or next year? I think we're getting quite close to it. We've got the triple whammy hitting them at the moment, or will be hitting them over the next 12 months, of the monetary tightening coming in with a rate rise on Thursday. And that's going to take a year to run through, or 18 months to run through. You've got the euro at just about record levels against the dollar, against sterling, against the Chinese yuan, and against the yen. And again, that's going to take another year, the full effects of that to run through. Then you've got the marked slowdown now occurring in a lot of their export markets. Essentially, the U.S. market is becoming extremely difficult for them to export into. Now Britain has gone down the tubes as well. And that's actually an even bigger market for them than the U.S., surprisingly, but it is, because we've had our own credit bubble here, and we've been buying German BMWs and Mercedes like crazy, but that's all having to stop. So they've now lost two of their most dynamic markets, and then now we're seeing signs of Eastern Europe tipping over, not Russia, but signs of the Baltics, and probably soon some of the other countries where they've got massive current account deficits. I mean, when I say massive, I mean some of those countries are up to 22% of GDP, like Latvia. In the Balkans, it's sort of 15, 16% of GDP. And I might add that a lot of these countries have funded their property bubbles by borrowing in euros and Swiss francs. And you can imagine what kind of train wreck is going to happen when their currencies start devaluing, and all these homeowners who've taken out mortgages in foreign currencies that are about to rocket on them 20%. Well, you can see what kind of trouble we're going to have here. Essentially, we've got mini Argentinas all over the place, which, as you know, when Argentina was in the dollar peg, they were able to keep it going for a while, and then it all blew up in 2001, and then the peso fell by almost two-thirds, and it was a disaster. Now, I think we're going to have mini versions of this in a number of parts of Europe. It won't be as severe as that, but there's elements of this creeping into the system.
Ambrose, this is a very grave picture of Europe.
I'm quite irritated at the moment by what's happening.
I can hear it in your voice.
I mean, one thing I'm particularly concerned about, people have different views about what the Federal Reserve is doing. I happen to think that Bernanke is doing the right thing by cutting rates to 2%. I was a major critic of the whole Greenspan experiment of holding rates very, very low for years and years and years and years. I think it created this bubble and this disaster we're now in. I think it was reckless. But anyway, we're here. We are where we are. I don't think the liquidation strategy that some people call for, where you just drive the whole economy into the gutter, would be a very sensible thing to do. I think we have to deal with it and gently deflate this thing and try and then right the ship slowly. So Bernanke is doing the right thing. The trouble is, there is a 1930s element in the global banking system right now, and that happens to be the European Central Bank, which is pursuing this outdated Bundesbank sort of monetary ideology, which is not adapted to the times. They have a very narrow outlook. They don't really understand or care about, until it's too late, the international consequences of their actions. And one German banker told me they're behaving like the Swedish Riksbank. A relatively minor bank for a minor country takes decisions without thinking about its effects on the rest of the world. Well, you can't do that if you're a European Central Bank. And they are now tightening into a very, very dangerous situation. And they're making life hell for everybody else, for the United States.
You're listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. You can find us at McAlvany.com. That's McAlvany.com. Ambrose, you've reported recently that the Royal Bank of Scotland, Barclays, Fortis, now Morgan Stanley, they're all looking for a significant